Let's take a look at this CVP analysis and cost structure problem. Due to erratic sales of its sole product, a high-capacity battery for laptop computers, PEM Inc. has been experiencing difficulty for some time. The company's contribution format income statement for the most recent month is given below. So we see they had $585,000 in sales, $409,000 in variable expenses, giving them a positive contribution margin, but then when we subtract $180,000 of fixed expenses, they're operating at a net operating loss. Okay, now requirement 1 says compute the company's contribution margin ratio and its break-even point in both units and dollars. All right, so how do we do that? Look at the bottom of your screen. Let me move this off the screen now. We calculate a contribution margin of 30% by taking the $585,000 of sales, subtracting variable cost of $409,500 and coming up with $175,000. If we divide the $175,000 by the $585,000 of sales, we come up with a 30%, and that's our contribution margin ratio right there. Then the next point is to compute the break-even points in dollars and units. Okay, now I've added this box right here that I'm circling that illustrates how we come up with the break-even points in units and dollars. So we know that profit is equal to unit contribution margin times quantity less fixed expenses. So if profit was at 0, the break-even point, we know that we had $30 per unit less $21 of variable cost, and we can calculate that because they gave $30 per unit. We take the $409,500 and divide it by 19,500 units. We can come up with the variable cost of $21, and that gives us a $9 contribution margin times the quantity less 180,000. So if we solve for Q, we wind up with 9Q equals 180,000. Therefore, working through the algebra, Q equals 20,000 units. So 20,000 units times $30 is 600,000 in sales, and that's how we come up with these values right here. Okay, next we tackle requirement 2, which appears in the middle area of your screen right here. Okay, the President believes that a $16,000 increase in the monthly advertising budget, combined with an intensified effort by the sales staff, will result in an $80,000 increase in monthly sales. If the President is right, by how much will the company's monthly net operating income increase or decrease? And we are to use the incremental approach to prepare this answer. Okay, so here's the incremental approach, and I'll show you what that looks like here. The incremental contribution margin is 80,000 of increased sales times a 30% contribution margin, so that gets us 24,000. Then we back off the 16,000 of increased advertising cost, so on an incremental basis, we expect to have net operating of $8,000. Okay, now if the company is now showing a loss of $4,500 per month, then the loss would result in a profit of $3,500. 8,000 loss less 4,500 of, 8,000 profit less the 4,500 loss, so we would wind up with a 3,500 profit. Okay, next we tackle requirement 3, which appears right here on your screen. Refer to the original data. The sales manager is convinced that a 10% reduction of the selling price, combined with an increase of $60,000 in the monthly advertising budget, will cause unit sales to double. Now what will the new contribution format look like? All right, let me illustrate that. Okay, now I've added this explanation here to solve requirement 3. What we see is that sales would be equal to 1,053,000. We would take 39,000 units times $27 per unit. And how we came up with the $27 is we said $30 less the 10% would give us $27. So 39,000 times $27 is 1,053,000. the variable expenses would be 39,000 units times $21, or 819,000, leaving us 234,000 of a contribution margin. And the fixed cost would be the 180,000 plus the additional 60,000 of the advertising budget. So 234,000 less 240,000 leaves us a net operating loss of 6,000. And you see those numbers dropped in right there. Next, we tackle requirement 4. We refer to the original data. The marketing department thinks that a fancy new package for the laptop computer battery would help sales. The new package would increase packaging costs by 75 cents per unit. Assuming no other changes, how many units would have to be sold each month to earn a profit of 9,750? Okay, so let me slide this out of the way. We'll show you how we calculate that. Again, profit is equal to unit contribution times the quantity less fixed expenses. So, if we want a profit of 9,750 and we had $30 less variable cost of $21.75, we've got to take that, multiply it times quantity, subtract the fixed cost of 180,000. And so what we wind up with is 8.25 Q equals 189,750. Solving for Q, we come up with 23,000 units. And little note here, $21 plus the 75 cents gets us that new variable cost of $21.75 per unit. Okay, next we tackle requirement 5, and I had to shrink the font a little bit so that we could see the answer without having to scroll. We refer to the original data. By automating certain operations, the company could reduce variable cost by $3 per unit. However, fixed cost would increase by $72,000. We're to compute on Part A the new contribution margin ratio and the new break-even point in both units and dollars. All right, let me grab this here and just jot this down so we can jot in the answers. All right, so the new break-even point would be fixed expenses divided by unit contribution margin. So we have 180,000 of fixed expenses plus 72,000, our increase, divided by the $12 contribution margin. And we come up with 21,000 units. That's our break-even in units. The dollars to break-even would be take the fixed expenses divided by the 40% contribution margin percentage, and we equal 630,000. That takes care of Part A. Okay, now you see Part B on the screen. And Part B said, assume that the company expects to sell 26,000 units next month. Prepare 2 contribution format income statements, one assuming that operations are not automated, and one assuming they are, and then show the data on a per unit and a percentage basis. So here you see, in this area here, what that would look like. If it's not automated, we'd have sales of 780,000, less variable expense of 546,000, so contribution of 234,000. On a per unit basis, it comes to $30 less $21 equals $99 contribution margin. And on a percentage basis, it gives us a 30% contribution margin. Then with the automation, we see that we've got 780,000, but variable expenses go down. Look at this. Fixed expenses go up, though. They increase from 180 to 252,000. On a per unit basis, our contribution margin rises from $9 to $12, so we increase by 10%. And you can see the end result is that with automation, we're $6,000 higher than without it. And that takes care of this problem, everyone.